What's up, everyone? Welcome back to my 3 stocks on sale series for the month of March 2023. In each episode, I use all the current market volatility to find 3 stocks that I think are trading on sale at today's prices for the long term. To make things a little more fun and interesting, I also choose one low risk, one medium risk, and one high risk option just to add a little more variety to the episode as well. As always, though, just keep in mind that this is all based on my personal opinion. Don't ever just copy what anyone else is thinking or doing in the market. Please do your own research and make your own decisions. But with that said, if you're still with me here, we got to kick off the episode with our low risk option. And I'm sorry because I know I talk about this stock a lot. You're probably sick about hearing it. But when talking about or when looking for a low risk dominance company that is trading on sale, there's really nothing that comes even close to the attractive all-around package that is Google stock, ticker symbol GOOGL, which in my opinion is the most attractive stock just in the entire market in general. And it's actually been falling even more now because of ChatGPT, but I actually think it's setting it up for a great buying opportunity for the long term, and I'm picking it up. And when I look at it here, I'm completely shocked that we still have not seen a significant rebound in the stock, as it has never really seen a crash like this in its entire history, falling for more than a year now, consistently trading near a 52-week low the entire time and being down close to half its entire value from the top, which is mind-blowing to me because you're now talking about an even cheaper valuation than the sector at a PEG ratio of only 1 that is a massive 34% cheaper. That's a huge difference for what is the clear market leader of so many internet-based markets like digital advertising, search, browser, mobile operating system, mapping, email, and more. And just going back to the chart here for a second, if we zoom into this year in 2023, year to date, you can see that it really wanted to recover. Guys, Google is out of its element here. It doesn't belong here at these lower levels. And I feel like it's a mistake to ignore that. That's why you saw it shoot up by almost 15% this year, trying to really break out of it. And I really think that it would have continued climbing if it wasn't for another speed bump popping up here out of nowhere, which is the viral ChatGPT trend. This is an AI chatbot that is backed by Microsoft that climbed in users faster than any other application in history, even ahead of popular apps like Instagram and TikTok, which we all know how viral those apps have become. And perhaps rightfully so, it scared the heck out of Google investors because Microsoft has now implemented it into various parts of their own business, notably their Bing search engine that competes directly with Google. And of course, Bing is just a tiny competitor at only 3% market share versus the dominant Google at over 92%. But if Bing was able to start stealing some market share, even just a little bit, it would still be a huge deal because Google generates over $160 billion just from Google search alone every single year. That's more than half the $280 billion that they do in total sales. Still, I think much of this is blown out of proportion, and right now is a great time to consider picking up Google at an unbelievably cheap price. First of all, Google has been investing in artificial intelligence for years, and they still spend almost 40 billion per year just on research and development alone. So you know that they have many tricks up their sleeves. One of which, by the way, is their own version of ChatGPT called Bard, which is so advanced that one of its software engineers even went as far as to claim that the AI chatbot was already sentient before later being fired by Google. And now they're saying that only a lightweight version of Bard is even going to be used going forward. So who knows how much more power Google has behind the scenes that they're not even showing us. But either way, Bard is already being tested under beta use and is set to release to the public very soon, which I think will actually make Google search even more attractive and may even provide some growth there as well. But in the meantime, though, Google is still a beast of a company regardless, doing close to 200 billion in sales per year and still managing to grow by giant rates like 13% in 2020, a mind-blowing 41% in 2021, and still another 10% last year. This year it's falling a little to 6% because of the horrible economy and the struggling advertising rates and things like that. And it's also a very hard comparison to the previous, really high growth that they had. But then next year it returns to double digit growth once again. And analysts also expect double digit EPS growth over the next 5 years as well. How is that not a buy? I mean, honestly, if anyone is bearish on Google stock for the long term, can you please explain to me why? Because from where I'm sitting, Google looks like the most attractive option in the entire market. Just my opinion. All right, guys, moving on to stock number 2. A lot of times I like to pick a dividend stock for our medium risk option, since the dividend can help balance out some of that risk by at least giving a nice return just from the dividend alone. And this month, right now, I gotta say, the pharmacy retailer Walgreens Boots Alliance, ticker symbol WBA, is starting to look very attractive once again. Now, you might recall that I actually started buying this stock myself late last year when it had crashed down to the low 30s. Right around this valley here is where I did all of my buying. However, since then, the stock had proceeded to climb back up to the 40s, and I no longer felt all that interested in purchasing any more shares. But since then, it actually started to fall once again, and now I think the stock is a buy right around this mid to low 30s range. And there's several reasons why I've decided to start adding shares to my portfolio once again. First of all, from the top, Walgreens stock has gotten completely destroyed over the years, losing more than 60% of its entire value, with the crash mostly starting around 2016. And don't get me wrong, there are legitimate reasons for all of this crashing. Not only have we been going through like a sort of retail apocalypse because of the rise of Amazon and online shopping that has sent so many traditional brick and mortar retail stores into bankruptcy, and that's really scaring investors into selling out of most traditional retail. But on top of that, management has done a really poor job of running the company, and that's why you've seen their profitability and their margins fall pretty heavily during that time, and also not experience a lot of growth, which correlates almost perfectly with the fall in the stock price. And so you have weaker profits now, slower growth, and a tougher retail environment where it's really hard to just kind of grow your sales from it. But in my opinion, I think Walgreens can still survive this and turn things around, because I actually love the moves that they've been making lately to adjust, and that's why I'm betting on it. First of all, they've been investing hundreds of millions of dollars in their online shopping infrastructure, especially during the pandemic, which, because they have so many physical stores already, over 13,000 globally, they've been able to adopt a more fluid kind of omni-channel approach to online shopping, similar to that of Target, Walmart, and Best Buy, where you can shop online and pick up in-store, which is convenient since about 80% of the US population lives within 5 miles of a Walgreens. Or you can simply have it shipped right to your door, since Walgreens can utilize their already built out very large shipping network that they would previously use just for warehouses and stores. Another huge thing that I love about them, though, is that rather than focusing solely on selling pharmaceutical and personal care products in the stores, they've invested billions of dollars into healthcare, where they're able to generate some much needed growth. By acquiring Village MD, which is a primary care business, they're now able to implement clinics into their own retail stores, which they plan to expand to over 1,000 locations by 2027. This adds more functionality and stickiness to each of those physical store locations, because people might go in just for products or to get healthcare services, or even both. And it's not just physical healthcare that they're investing in, but virtual care as well, with Walgreens Health and CareCentrix, which already has almost 20 million members. The result is that Walgreens business is now experiencing huge synergies, because you can get treated both at home and in the clinic. And when they prescribe you any medication or you need to buy any personal care items, it's all right there, either online or in store too. It's an all-in-one kind of Walgreens ecosystem that you've got going on here. And the result is that their financials are now stabilizing. They're expecting some light growth again, both this year and the next, on their sales, which, by the way, they just increased their guidance this last quarter too, at a time when most other companies are lowering it because of the horrible macroeconomy. And their EPS is also expected to grow over the next 5 years, while it was actually negative in the previous 5. And all the meanwhile, the falling stock price has left a dirt cheap valuation that is over 60% cheaper than the sector, and essentially a record high dividend that has never reached these levels in history, with a monstrous yield of about 5.5% on almost 5 decades of consecutive growth. That's almost dividend king status. Plus, the payout ratio is pretty good at less than 50%, and the current share price is also lower than even the lowest analyst price targets as well. So I think what I'm left with here is a dirt cheap stock price for one of the best dividend payers out there. And I know that the investments are going to take time to really help the business kind of turn around. And in the meantime, it is going to weigh heavily on their profits and their profitability. But I do think it will pay off eventually over the longer term. And in the meantime, like I said, I get to collect one of the best dividends out there. So, I'm comfortable buying the stock. I think it's going to be volatile. It's going to be very bumpy. It can certainly go lower from here, but I'm okay buying it in small amounts as it falls. And I think it does fit this kind of medium risk option slot here very nicely. All right, guys, that's going to leave us now with the third and final stock of the video, which is also our high risk option. And this month, when talking about high risk, speculative kind of stocks, I really think that one of the most attractive that has been falling a lot recently is the Chinese electric vehicle company NIO, ticker symbol NIO. And this is a stock that I used to own myself. Then I sold out of it for a giant profit, but then I bought back in late last year because I saw the price falling once again down to around only $11 a share. But since then, it's actually fallen even more, now down to just the single digits at around $8, leaving it down a gigantic 87% from the top. I mean, this is just a monumental crash here that we're talking about, and in many ways, it's not even really NIO's fault. A large reason for the crash was the broader technology market falling in general, like we saw with the NASDAQ, as well as SEC regulatory concerns that NIO could be delisted from the US. But most recently, the US actually conducted audits and said that for the first time in history, they were able to perform complete audits of Chinese companies with full access. So I really doubt NIO will be delisted anytime soon. But then on top of that, you also had the Chinese economy being in limbo because of the continued lockdowns and shutdowns of factories, many of which affected NIO directly for weeks, if not months at a time. And that led to huge supply chain disruptions, among other things. And yet, despite all of these hurdles, NIO has still been able to expand their business at an unprecedented rate, both domestically and even internationally. First of all, sales have been soaring year after year, growing to almost 100 billion yuan this year, with growth rates of over 50% in 2019, triple-digit growth in both 2020 and 2021, despite the horrible conditions in China. And then they finally shrunk down to 37% growth last year, but that's coming off of the gigantic growth prior. Plus, it's with the fallout from rising interest rates and a horrible macroeconomy. Plus, it's still pretty good growth at almost 40% at a time when most other legacy automakers are struggling to grow at all. So I'm not sure it's even bad at all. But then later this year, they're still expected to rebound regardless, at all the way back up to a monstrous 86% growth rate thanks to all the expansions that they've been making. In Europe, for example, they grew their deliveries by over 400% last year, and while that's still a very small total number, it should become much larger over time thanks to the 5 brand new models that they're launching this year that are built on the new NT 2.0 platform, which is actually one of the biggest reasons why the stock is falling right now, believe it or not, because last quarter, their margins took an unexpected crash down to the single digits, and everyone is panicking that this might be the new normal for them. But that couldn't be further from the truth. In fact, if you actually listen to the earnings call or read through the presentations, you would know that the margins have only been falling because of the supply chain disruptions in China, coupled with the fact that they're trying to clear out old inventory that was built on the previous platform, which is leading to customer cancellations because they're choosing to not buy the older models. However, most of these cancellations were because NIO offered them incentives to purchase the new vehicles instead that are built on NT 2.0, some of which haven't even released yet. So in the short term, you're left with this backlog of inventory that they need to get rid of, which is destroying their margins. But over time, that will get cleared out. And once the sales convert to the new ones, the margins should bounce right back up, which we've seen in the past that NIO can do margins north of 20%. And that's way more profitable than legacy players like Ford and GM in the single digits. So while NIO continues to lose money right now, that should turn around soon in the future. And that's exactly what NIO has stated, that they still expect to become profitable despite all the hurdles that they're going through, which I think would be pretty freaking crazy if they're able to achieve that. I think the stock would likely soar on that news. Meanwhile, though, it's all systems go for the new models, and two of which, by the way, have already made it to the top 10 premium sedans list in China. And if you think that's impressive, you should know that the only two cars on that list that are actually fully electric are both from NIO. Which is pretty interesting. And I think things are only going to get better from there. This year, NIO is not only building another 1,000 power swap stations, which they already have 1,300 of in China, and is a big differentiator when it comes to buying a NIO over the competition, because you can swap your battery out in 5 minutes. You can get a subscription plan that lowers your initial price tag. There's many benefits to it. But on top of that, they've also chosen the location already for their new factory to build a brand new mass market brand that will make cheaper EVs for the entire world. I believe the plan is to first launch it in China by next year and then start shipping them out to Europe and the United States shortly after. And I think that has the potential to sell very high numbers in each of those markets, because they're even aiming to price them lower than the cheapest Teslas. And yet the stock has crashed by so much that we've seen the valuation go from a price to sales ratio above 30 all the way down to just around 2 today, which I think is more than reasonable in terms of a valuation. So I continue to say NIO is not a perfect stock. In fact, it's super high risk and it's very speculative, but for what it is, accepting that it's high risk, accepting that it's a spec stock, I actually think it's one of the most attractive spec stocks out there, one of the best options. So it's not a stock to go out there and aggressively buy in large amounts, but I do think that it's a stock that I can chip away at in small amounts as it continues to fall, because I like how aggressive they are in expanding the business domestically and internationally. I think they still have a lot of future potential, and I think it's a gamble, but it's a stock that I'm willing to bet on in small amounts. But anyway, those are just my opinions, guys. I'd love to hear what you guys have to say down below. Do you agree with any of these stocks? Do you disagree? Why or why not? And would you make any changes to this list? Would you be buying a different stock instead? I'd love to hear your thoughts, and I may include it in a future video. But thanks again for stopping by, everyone. I hope you're all doing well. Take care, my friends. I'll see you next time. Bye-bye.